Hello folks. Welcome to this episode of the mentorship. This is going to be the third installment of the 10-part series of the TW Inc. Mentorship 2025 YouTube. And this topic is actually a combination of, questions and suggestions from the community, right? And although it was already pre-planned, but it kind of give more heads up that okay, this should be the next after talking about the high time from institutional order flow. So if this is your first time watching, I already released 2 episodes. The first one being defining the high time from institutional order flow via quantitative analysis, that's using the COT hedging program. That means we want to use data to define what order flow is, right? And it actually makes sense because the US economy, for example, the world economy, most countries are practicing a capitalist economy. And one of the symbols of capitalism is a free market system. And if we are speaking of based off a free market, especially the United States of America, they always want every participant to experience a quote unquote free and fair market. Although we know it's not actually free and fair. I'm not trying to be what's the word, to be a propagandist anyways. I just want to say that it's not the way it's designed, okay? But every person has the sense that the markets are free and fair, and to a large degree and extent it's free and fair. If not, we wouldn't be able to speculate in the market. At least that's some add-ons. We can, nothing is perfect, right? So what I'm talking about free and fair markets is the fact that large institutions, their positions are always being published, and it's on the CFTC website where you see the commitment of traders showing the active open positions of institutions in the market. Now, when we can see what they are doing, literally, and these are folks, organization, and entity that controls global commerce and stuff. So whatever they're doing, they interpret global commerce. And for example, the current tariff in the United States, these guys are going to interpret it however they're going to interpret it, and it's going to reflect on their actions. And what's their action, their positions, okay? And we now see it in the commitment of traders report. Now, we don't just look at the commitment of traders report, we look at it through the lens of the hedging program, okay? And I think I don't know if I talked about the advantage or disadvantages of just looking at it directly from the commitment of traders report, because in their actual report, whether they are long or short, there is the hedging program that defines what they are doing part time. You understand? And that's the advantage of looking at markets through the lens of the COT hedging program. It defines institutional order flow part time. Okay, it's not just giving an overview of what commercials are doing, whether they are net long or net short, or whether they are in a buy or sell program. It's telling you actually what they are doing, their hedging program. Okay, are they actually buying? Are they actually buying in a buy program, or they are selling in a buy program, or are they actually selling in a buy program or selling in a sell program? Okay, so that's what the first episode was about. And the second episode, because this is, I'll have to start with a recap because each episode ties into the next. Okay, the next one was looking at candlesticks. Okay, candlesticks to define what the higher time from institutional order flow is. And we kind of talked a bit about market structure, saying that when high time frame, we mirrored high time frame institutional order flow into candlesticks. That's market structure, right? And that's what the second episode was about. And saying that when you have institutional order flow, you can just look at candlestick, especially on the monthly time frame, and you can define what the next draw on liquidity is. Because one of the summary of the last lesson was the draw on liquidity, because because we talked about defining draw on liquidity in 2 ways. One, we want to define the draw on liquidity when it's in line with the long-term trend of the market, and we want to define the draw on liquidity on the high time frame when markets are probably making corrective moves, because that's only when the draw on liquidity is always opposing the long-term trend of the market. Because I'm trying to get two things, but sometimes they mean the same thing, because there are periods when the draw on liquidity is in line with long-term trends. For example, during the report on Monday, that's our weekly market review, and I talked about April's draw being March's low, and also talked about some discount fair value gap on the weekly time frame. Okay, if we look at the weekly chart, you'd see the discount fair value gap. Oh, I kind of like had this recording earlier today, but I had to do it again. All right. So we have a discount fair value gap here, and these were the two objectives we're talking about. Saying, we talked about last week's candle and the potential of this week's candle to possibly run into this previous weekly high and all of that. So that's one of the bases for this lesson. It's how do we validate the high time frame institutional order flow? How do you validate it? Because if I have data, for example, I can see the company of traders report. Okay, if I have data, for example, and not, and I'm looking at the chart, how do I know when to submit to data? Okay, how do I know when to submit to the high time frame draw on liquidity? Because most of the times I always say what is pertinent, what is more important is you focusing on the long-term trend of the market, because that surpasses everything. Okay, markets can play out however they want to play out, right? So let's take, for example, let's look at it from the perspective of the monthly time frame. Okay, if we're in a monthly chart and say we're here, for example, okay, let's have this drawn out. Let's have this drawn out. I'm going to use a tiny portion of the line, and yeah, and you see the markets took out sell side liquidity here, and if we try to go back to old data, for example, because somebody was asking about the COT hedging program not being consistent when you go back to 2021. It's a 1 year range primarily. It's a 1 year range. Okay, when it skips, once it goes outside 1 year, it's not consistent, right? It's no more consistent, and I would not do that. And that's why you're like, okay, then how do you know? Well, you want to go to my Twitter account, for example. You can check when I started making the commentaries in 2023. All of the commentary I posted through my Google link, you can check it out and see how I was talking about price and see what it is now. Okay, and I don't have any data to back 2021 price action because you weren't with me. I wasn't online. Okay, I wasn't on social media. Okay, so we can't be talking about it now. Let's focus on what data is saying today, now, okay, in present, and how we've been consistent talking about the markets. I think that's what you want to lean on, because the thing is, when people come in here, for example, and they're learning about COT, it's very hard to trust it, because even myself, I found it very, it took a long time before I started trusting it, and it took a lot of filters, because someone now, for example, like, okay, why can't I use the COT hedging program in Euro USD, in GU? It's not, there's a lot of lag. In dollar index is better. Okay, I've used years to define which one I'm going to use, because sometimes DXY is bullish, Euro is bearish, and I'm like, okay, what's going on? And funny, in the end of the day, they all overlap, but there's a lag. Now, how can I merge all of those lead and lag time? Because sometimes Euro USD is already bullish and dollar index is still bullish. Probably now takes a week, 2 weeks, 3 weeks, DXY shows bearish. Now, since DXY is a barometer I use to measure relative strength between dollar index and foreign assets, I just simply look at dollar index, and dollar index has been the most consistent over the years. Okay, it took a lot of time to actually see for myself data that, okay, I'm going to stay with dollar index, because when ICT Michael talked about the COT hedging program, he looked at, dollar CAD, it looked at pound and all of those other pairs. But when I brought it to my own analysis, it wasn't, there was a lot of lead and lag time. And that, the early years made me distrust the hedging program. Okay, that's why now I just look at the dollar index and I look at market structure. Okay, dollar index and market structure. So in this period here, that was September 2024, we can see we are above the net zero line and dollar index is bullish. Okay, so in this case, now that we understand that DXY is bullish, say in hindsight, we don't even need to look at the hedging program, and we understand DXY is bullish. If you look at something about September's closing price, you can see September trades below August low and closed inside the range of August candle, creating a fair value gap. Now, ideally, even if I don't have any sight of what's it called, the hedging program, and I'm just looking at candlesticks and I see all the bodies of this candle still closing above this candle's low and there's a fair value gap, the draw on the liquidity for me first would be markets returning into this gap first. Okay, because I can say, okay, look at this candle, 1, 2, 3, 4. We have a change in state in delivery here. and we have a fair value gap. Okay, so I want to see the markets trade into this gap and probably trade lower into sell side. But because of the high time from institutional order flow, I know this is not a market structure shift. I know this is a torso. I'm seeing it from the lens of institutional order flow first before I interpret market structure. I use institutional order flow to interpret market structure, not market structure to define the higher time from institutional order flow. And now that I know this is unlikely to be a market structure shift, and we're bullish, and a run below previous monthly low and a closing basis inside this monthly range also validates the fact that this is a torso. Now I can now go in this month of October looking for longs. Now, since this is the monthly time frame, okay, since this is monthly time frame, how do I validate order flow? How do I know when to join in? Now, there are about two things. Okay, the first one, market structure and the change state of delivery. Okay, and the next one is you want to use candle ranges. All right, so for example, now this is a monthly time frame. If we go down to the weekly chart, okay, I need that to show. I need it to show. Okay, you know, I'm gonna use some other dollar index chart so that it's kind of easier. I don't want to. All right, so we have this markets trading below sell side here, and markets trading sell side, you know, gonna make this one very thick. Okay, and yeah, market structure. So I said, how do you validate the higher time from institutional order flow? Because if institutional order flow is bullish here, and we have low resistance liquidity run signature here as in lower high, and I'll just need to go to the daily time frame because it's high time frame market structure. Okay, monthly bias. Okay, we have a run below, you know, an old low here. So I just need the daily time frame to validate my bias. And how do I do that? Well, now we look at market structure. Now, if you want to look at market structure here, you know, everyone is going to have a different ideology about looking at market structure. Someone can say, okay, this is going to be my reference point. This high is going to be my reference point. Someone is going to come in and say, okay, this candle's low is going to be my reference point. And it gets very, very complicated. So there's a way to actually look at it, and then we can now drop back down to the lower time frame. For example, we can go into the weekly chart and say, how does the weekly time frame respond to the monthly bias? Okay, how does the weekly time frame respond to the monthly bias? Okay, now that we're bullish and markets are below an old low here, okay, you can see this candle, okay, this bullish candle. Okay, this bullish green candle that traded through this consecutive 1, 2, 3, 4 candles. Okay, as soon as this candle closed above the open of this candle, okay, that is your change in state in delivery. As soon as this green candle, okay, closed above the body, it can close anyhow, really. It can close somewhere close here, it can close above, but as soon as we have this is validating a change in state in delivery on this candle. Okay, so this 1, 2, 3, 4 candle is our order block. Okay, what's an order block? Well, an order block validates a change in state in delivery and associated with a run on liquidity. What liquidity? We have this low here as a reference, and also you can see this low that the market's engineered here. So you can see this short-term low here engineered, and market ran through this candle, and we have to reference this candle, the consecutive down candle that ran liquidity here. Okay, that's how you validate the high time from institutional order flow. And when this happens, every other week you want to be expecting upside until objective is met. Now, mind you, there are other key details you want to look at, like premium and discount, because when markets get into a premium, you can see there's markets offered a retracement. Okay, but that's for later. You can look at the commentary from last year, and you can see how we talked about the markets every single week. I think I started producing on the 11th of October on my YouTube channel, and you can look at how we were defining the high time from institutional order flow every single week, including this week and the rest of that. So how do you validate the high time from institutional order flow? Market structure in form of what? The change in state of delivery. So when there's a change in state in delivery and it aligns with the higher time frame institutional order flow, now you have market structure overlapping that. That's how you validate the higher time frame institutional order flow, the long-term trend in the market. Now, the same thing, if we look at January's trading, if we look at January's trading, we're talking about DXY being bearish in January, okay? And essentially, after the markets, after we traded through and closed this imbalance here, okay? As soon as the market closed this imbalance, okay, you can see very, very similar price action, very, very similar price action, because everything is in candlesticks. Okay, when we look at the weekly time frame and we saw that the weekly time frame closed green, not just any random green candle, after validating a change in state in delivery above these candles open. Now we know that every single week, any trade we get in on is likely to be a potential swing trade. Why is this going to be a swing trade? Because of the COT hedging program. We know that it stays between minimum 3 to 6 months. Sorry, I'm having hiccups. 3 to 6 months. Okay, and you know that once you have this validation and you take a trade, someone who is a swing trader can buy the opening of this week's candle and place their stops here and hold for the bulk of the range. That's an ideal swing trading model. That's an ideal swing trading model. It doesn't get better than that, really, if you want to take swing trades. Okay, so let's take a look at this year's price action. And I was talking about DXY being bearish since December's trading. Okay, when we knew that dollar index was bearish, okay, you can trace it back December. You can go, mind you, we use daily time frame, not the monthly chart, but for the sake of having to go to daily and all of those time frame, let's stay on monthly time frame. So around mid-December, we're already looking at potential bearishness on dollar index. That even validated the close of this imbalance as our objective. Okay, because now institutional order flow is bullish. We want to see markets rebalance inefficiencies like the way markets are currently rebalancing inefficiencies. I think I talked about this in previous videos. So after the close of this imbalance, you can see January's trading close inside the range of December's candle, just like the way September trading closed inside the range. This itself, it's a validation, because before you can literally validate the high time from institutional order flow, the first thing before you begin stalking market structure and you change state in delivery, you want to have a reference point, and your reference point is going to be a key level. And key level could be a fair value gap, a close of a fair value gap, a bearish order block, an old low like this, an old low like this, okay, an old high like this in reference to a key level, an old low like this in reference to a key level. What key level here? We have an old low here. An old low is a discount array. Now, if someone want to say, okay, Settle Black, what about this? You can look at the rejection block here, and you can split this rejection block into half. Okay, when you split into half, you can see the 50%, the consequent encroachment. You can see that's where the market is. Okay, you want to do that. Okay, it's a key level in reference to the high time from institutional order flow. That's why our objective was the close of the monthly gap, because institutional order flow on dollar index was bearish, and we are approaching the close of the monthly gap inside a bearish order block. So you can see how this candle closes inside, validating February to be bearish. But the whole Trump thing has been very, very crazy this year. I mean, it's been very, very crazy, messing with price action, markets running overnight, markets running throughout the weekend, and all of those kind of stuff. It's not been very, very funny. So you can be right on bias, and you can be faced with situations that are still beyond your control. And that's what most people do not understand, that you can be right in your technical analysis and you might still not be a participant of the market, because there are some things beyond your control. We can take, for example, this week's trading, how markets moved overnight for Thursday's trading. That's beyond your control. And if you say because of that you're going to break your rules, well, the market will teach you a lesson, because these kind of things don't happen every single time. And when they happen, they catch you off guard, and there's literally nothing you can do about it. There's absolutely nothing you want to do about it. Okay? So now, that being said, when we have Generally trading like this, validating high time from institutional order flow. We talked about it in the YouTube channel. I know it's very hard for me to pronounce the commentary. I don't know why. I don't know. It's kind of like funny. I can't pronounce it. Anyways, then you have February's trading. Now, how do you validate February's trading? Well, if we go to the weekly time frame, okay, you want to see markets change its state in delivery. And how do you want to do that? Well, you can look at this up candle prior to this move lower. That's a change in state in delivery. That's a change in state in delivery. Now, this is one way. The second way we want to look at, you can look at daily time frame market structure, but let's stick with the weekly time frame, okay? Because if you can look at weekly time frame and define market structure, of course, you can also interpret on the daily chart. Not just that, you want to be seeing markets, okay, violate, premium arrays and respect discount arrays. For example, if you look back here when we're bullish, you can see there's been a fair value gap here. You can see fair value gap here. Yeah, you can see this fair value gap here. So this was an old gap of offering resistance here into sell side. Then when institutional order flow was bullish, markets traded through this old fair value gap, closing through. You can see why candlesticks are very, very important in your analysis. Candlesticks, the open, the high, the low, and the close, they all have meaning. We looked at the monthly time frame to show how just from the monthly close, we could already tell that likely we're going to see markets trade in the direction of the monthly buys. Just with candle closing inside the range of these candles, of August candles range, just the way this candle traded and closed inside this candles range, this itself is a trading model. I mean, when we get to day trading models, I can show you how we can get very creative with this. For example, you have a 4-hour time frame level and markets trade into the 4-hour time frame level, and markets create this kind of candle. You can just, this is the 4-hour time frame and markets create this kind of thing, I can sell the next candle and place my stops above this high, probably a couple points, because there's every potential markets can trade above this high because the markets are probabilistic. So if this is a high resistance level because we've traded into a key level close the fair value gap, and this is high risk. If market runs through a level of high resistance, that's a Tory soup. That's a Tory soup, basically. Okay. So if you want to place your stops, you can place your stops a couple points above your stop loss, because markets can actually revisit this kind of levels. I can show you multiple times on this chart where markets aren't supposed to go through levels and they go through them. That's the point of knowing high time from institutional order flow, because if market trades above previous monthly high, when high time from institutional order flow is bearish, that's a Tory soup. I talked about it in the last installment, saying how market structure, you use institutional order flow to define market structure. A run above a previous monthly high when institutional order flow is bearish is a Tory soup. Simple as that. So if you get in on a trade, say you want to run swing trade, position trades, whatever, and you get in at the open of the next month's candle, and you place your stops a couple points high, and markets trade above this high, you're not afraid, because you know that the markets should reject immediately. It's not supposed to happen. And that's what Tory soup is, manipulating market structure. Okay, so let's go back there. Let's see the weekly time frame. You can see that how do we validate the weekly buys? Okay, via a change in state in delivery. Okay, like here, markets close above the bodies of this candle. That's a change in state in delivery. Market is violating premium arrays, levels that potentially acted as resistance previously, and markets would utilize it for support. Now, can the markets trade back here? Yes. And can the markets not trade back here? Yes, of course. And that's why if you're going in this week and you're bullish, but you have an expectation for the markets to trade into a high time from key level, well, this is the video for you. How do you validate the market doesn't return here? Because someone asked me on Twitter saying, I want to learn Black, I want to learn the weekly profiles. Well, you don't necessarily need to learn the weekly profile, because if you're learning the weekly profile, you're putting yourself in the box that, okay, I'm going in this week, I believe that Tuesday is going to be the high of the week. Oh, I'm going in this week, Wednesday is going to be the high of the week. Oh, I'm going in this week, I'm anticipating manipulation this week. Well, what if the manipulation doesn't happen? How do you adapt? Because before you anticipated Wednesday being the high or low of the week, before you anticipated Thursday being the reversal, you had a bias going into the week. And that's what most people forget about. You had a bias, and that bias transcends your expectations. It transcends whatever intraday play you're expecting the markets to do. Because when market structure begins to validate that bias, you have to join in. Now, I started this video with looking at it from the monthly perspective and how you use the weekly time frame market structure to validate that bias. And when we keep on talking about it, it begins to open your mind that you could actually take trades on swing. You could actually go on swing trades. Yeah, basically, you could actually do that. It's very, very possible. And you can see, like, our this portion of price action, we also have a fair value gap. Okay, and this fair value gap became the inversion gap, and that was one of the hallmarks of the things we were looking out for. I think trading is going to be easier if we look at it from the lens of swing trading and stuff, because if you can look at the high time frame like this and see this up candle and market close below this up candle, this is your order block. Okay, this is your order block. In fact, this is your propulsion block. Why? It traded into 1, 2, 3 consecutive up candles. Okay, and when market returned back into it, it's short. Now, can the market consolidate here? Yes. Can the market trade into a premium? Yes. But none of that happened. And in hindsight, market is just respecting this order block. Now, if you're bearish, how do you now validate your bias? Because in this sense, this would be, if we look at this candle, this is the end of February's trading. That means the end of February's trading, the market's just returning to this order block at the end of February's trading. Now, if you look at your charts and you go through March, and you can see for March trading, market hasn't traded into this gap. Market hasn't traded into this gap, and February closed bearish. Your monthly bias in March is going to be bearish, and your target will be what? Previous monthly low and into this gap. And obviously, you want to see markets trade into this discount fair value gap. Now, if you have a bias and you probably have some intraday expectations that the markets can maybe or not trade into and stuff, okay, how do you validate? Because this is the close of February's trading. How do you now validate March bias? Because now that the monthly candles has formed, you can't use the monthly time frame to validate the institutional order flow. This already validated the high time frame institutional order flow. This already validated high time frame institutional order flow. So you're literally not going to see, consecutive down candles here. You have to be treating it every single week, because when the monthly bias has been validated here, it now becomes each single week. You have to define an institutional order flow every single week. What's the draw on liquidity this week? What's the draw on liquidity that week? But it's different when we have a shift in trend, because when there's a shift in trend, you want to wait. And what are you waiting for? You want to see a validation like this on the weekly time frame, or you want to see a validation like this on the daily time frame, whichever way. But say the weekly time frame, because it's more condensed, all right, and you can see it. It's more cleaner with price action, because if we take this to the daily time frame, it gets a little bit messy, because I showed you the daily time frame here, and you can see there's always a confusion, and we are not trying to cherry pick anything. Okay, we don't want to cherry pick and say, oh, look at this down candle. As soon as this candle closes here, that's a change in state in delivery. Someone will say, settle black, what about this high? Or what about these consecutive down candles here? Because if we go through other time frame, like 2-day time frame, 3-day time frame, 5-day time frame, there are other time frames there. So how do we now have like a universal model that answers the questions? Well, it's very simple. We just go to the weekly chart. And in the weekly time frame, everything is more condensed, and we can see all of these candles. So we have an inverse fair value gap, markets violating an old premium array. That's validation. Markets closing above these consecutive down candles. That's validation. And with what? With respect to what? A key level. Okay? You have a key level as reference point. You have a change in state in delivery and market structure. And you have this candle range. Just this green candle validates the monthly bias. Now that we've talked about it, we've looked at it from the lens of the monthly time frame, and we can see a change in state in delivery with respect to a key level, and you can see markets give off discount arrays and utilize them for support. Okay, and unlike here, market didn't return back there for support. So you can see the markets can move in a myriad of ways, and that's why you have to have the probabilistic mindset. Okay, let's look at this piece, this portion of price action when markets were bearish. Now we have here, we have this down candle here, and if we look at other brokerages, you can see, and someone looks at this and say, oh, we already traded into this fair value gap. Oh, this week is going to be bearish, but did you anticipate markets returning back here? Now someone will be saying, oh, markets ran above previous weekly high because market hadn't traded into these consecutive up candles. But do you know it's very possible for the markets to not trade into these consecutive up candles and still deliver this much range on this week? That's probabilistic thinking. So how do you manage your expectations in periods like this? How do you manage your expectations? Okay, and that's why if we have a weekly bias, which is bearish, we want to study the 4-hour time frame market structure in reference to a key level. Okay, now this week, for example, you can look at this. We had consolidation Monday, Tuesday, up until Wednesday, and you can see what happens here. You can see what happened at the close of Wednesday's trading. What the market do? Market close below this consecutive up candles. That's a change in state in delivery. That's your bearish order block. Or someone can say, if we reference it to this down candle here, that's your mitigation block. Because someone is saying, Shadow Block is calling a mitigation block or a breaker a bearish or bullish order block. Well, it's if you're referencing this down candles here, that's when it makes it a mitigation block. Or you can call it a breaker because there was a run above relatively equal highs here. But if you look at this candle, this is your bearish order block. And as soon as the market closed at this candle, this becomes an order block with this fair value gap showing sponsorship in line with what the monthly bias. Because what's the monthly bias today? And the weekly review, we talked about the monthly bias. We said the monthly bias for this month is bearish, and we want to see the markets trade into March's low, and not just trade into March's low. We had levels on the weekly time frame we wanted to see the markets trade into. Okay, for example, if we go through the weekly chart, we talked about this discount fair value gap here. Okay, we were eyeballing this fair value gap as a discount already. We wanted to see the markets trade into. Okay, not just trade into this low. We want to see the markets rebalance and see how the markets are a self-fulfilling prophecy with the tariffs in the United States and all of that. Markets just ran overnight. Now, how do you validate bias? You want to validate it in terms of market structure. Okay, market structure, change in state in delivery. Okay, with reference to a what? A key level. A key level. Now, if you look at the previous weekly candle, in hindsight, again, in hindsight, we might make arguments. Oh, the previous weekly candle closed inside the range of this candle. Of course it did. And that's why we talked about the possibility that this week is going to be bearish. But markets consolidated until Wednesday and now showed sponsorship on Wednesday. Now someone can come in and say, oh, the weekly profile is midweek reversal. Well, it doesn't really matter if it's a midweek reversal, a Thursday reversal, or a classic Tuesday high of the week, or we're forming Monday high of the week and stuff. It doesn't really matter because before the market runs to objective, there's going to be a shift in market structure. And that shift in market structure is going to be validated by a change in state and delivery, like what we see here. I mean, last week's trading, we're talking about how, the markets already met objective and TVC, because we've had different price action across brokerages, which is very, very complicated. It's kind of like complicating price action. Okay, it's making it difficult to read, and you have to watch two sides primarily. But then you can see when this candle validated a change in state and delivery here on my Twitter account, I was talking about how we can begin looking for short. But on Monday market open, markets were already trading to sell side, and if markets run sell side, you want to wait. And now there's a potential that markets can trade into this high. It's a probability, just like the way we called markets running here probabilistic. Markets running above here is probabilistic. Anything can happen. So it's not about okay, markets ain't traded, but markets will do anything market want to do, literally. And that's why I'm teaching this, how to validate the high time from institutional order flow. Because if markets runs here, it's manipulation. Why is it manipulation? Because we saw the weekly time frame. We looked at the weekly time frame and we saw that on TVC, market has met objective. on my capital.com. Market is met objective. If you look at it, very different price action. Market is met objective. Market hasn't traded into this gap, an ideal level we wanted to see for continuation. But on TVC, we talked about it on the Monday market report. Okay, and market traded into it. I'm struggling to see commentary. I'm struggling to say, I don't know why. So if markets even run above here, that is going to be a manipulation and a torso, because this already validated April's bias. Because we're damn sure that April draw on liquidity is this low. So if markets run through here, it's going to be a whole lot of manipulation. And that's what I was talking about. And we were seeing reports, we were seeing price action on Monday's trading. You can see we're seeing Monday respect the order block here, and market began to consolidate. Now, look at this bearish order block here. And as soon as market started to consolidate, I was saying on Twitter, I'm not doing anything. I just want to stay on the sidelines. Okay, I don't want to be a participant like this because I know I'm likely to be wrong. And you can see this old gap. You can see this old gap. Markets has been failing to close below this old gap. Now, what was the characteristic I said when you want to validate the higher time for institutional order flow? Old levels of support becomes resistance. An old level of resistance becomes support. Markets, this was formerly resistance here, and it became support, took us here, objective, and as soon as the market closed below this old level, you can see we're making reference to key levels. We are talking about inversion, because when premium arrays are giving way for upside moves, that's inversion, because they become inverted levels. That's simply what happens. So we want to reference a key level, change state in delivery, market structure, and candlesticks. Look at if institutional order flow is bearish and Wednesday candle closed bearish, what would you anticipate for Thursday? When we're very close to sell side relatively equal lows and the draw on liquidity, the weekly fair value gap here, Thursday becomes bearish. And how do you validate Thursday being bearish? It's the 4-hour time frame, because we're talking about the weekly bias, not the monthly bias. If you want to validate the monthly bias, you look at the weekly time frame. But now this is the weekly bias. You look at the 4-hour time frame, or you look at the individual daily time frame candlesticks. And that's why I just mentioned here that Thursday was what? Sorry, Wednesday was what? Bearish. Wednesday giving off the what? The weekly bias. So if you're looking at weekly bias, you can look at the individual daily time frame candlesticks for validation of a weekly bias, or you can look at the 4-hour time frame market structure. And how do you want to see it? You want to see a change in state of delivery. What is the change in state in delivery? On this candle's open, as soon as this candle closed below this candle's open, that validates a change in state of delivery, making this an order block. Fair value gap, whoa, sponsorship. Is it every time we get to say fair value gap? No, with the change in state of delivery. Is it important? Not really. What's more important? The higher time from institutional order flow. Now, if we look at price action on Euro USD, very, very interesting this week. This was the level where I was talking about potential shots in Euro USD. If we check the hourly chart, you can see these consecutive up candles. And as soon as the market closed below here, short, and market returned back, consolidate, ran into previous day's low again. And I was talking about markets being consolidation, and I don't want to be a participant anymore. Okay, now let's go back to the 4-hour time frame. You can see the same level, this bearish order block. If you can look at it and look at this down candle that ran liquidity here, can you see it? When this candle closed above the bodies of this candle, that is your change state of your delivery. That is your bearish order block. Someone like Settle Black, what about this candle? You can see this candle is inside the range of this candle. This candle traded through the high of this candle, running buy side and running sell side here. So this is our reference point. This is your bullish order block. And you can see how markets are switching roles from bearish order block still within the same range, and this becomes our bullish order block. And you can see the markets return back into the order block, and markets just ran away to objective. Okay, because this is objective we're talking about on the weekly time frame. On the weekly time frame, what were we looking at? Well, just like dollar index, we saw how this candle closed inside the range of this candle. Look at what we're eyeballing, the close of this fair value gap. Imagine somebody going here looking for more upside. Look at what's happening. But am I going to go short? No, I'm not going to go short. I'm just going to leave the markets like that. because the market can continue going higher. But it's low probability because market has met objective. So you want to wait. So that's how you validate the high time frame institutional order flow. You want to look at market structure, or you want to look at the daily time frame candlestick if you're looking at the weekly bias. Then if you're looking at it from the monthly perspective, you want to see the weekly time frame change state in delivery. And that's how you validate the long-term bias of the market. Now, one very beautiful example this week was USDJPY. I was looking at USDJPY over the weekend, and I can't really discuss all markets in the market review on Mondays. It's going to take a whole lot of time. So we discuss dollar index and we mirror it in different assets. I mean, look at USDCHF. I mean, we're talking about USDA returning to this gap. USDCHF never returned into this gap. But notice USDCHF ran above previous week's high. Whenever someone is asking me, Settle, what do you think about liquidity? Well, look at previous week's high, previous week's low, previous monthly high, previous monthly low, previous day's high, previous day's low. Because instead of looking for liquidity on lower time frame, each candle range from the daily, weekly, monthly, they're offering you market structure and they're offering levels of liquidity. It now depends on when markets are going to run through the previous day's high and previous day's low, and that's how you're going to blend key levels. So let's go to USDJPY. You can see how markets were trading higher, and I took longs on UJ last week and collapsed, very close to the bearish order block, and I was aiming for some previous day's high. I think I closed at the previous day's high, and you can see how this candle closed inside the range of this candle when we're anticipating dollar index to be bearish. Now, if you go through the daily chart, something very interesting. Okay, if you walk through the daily time frame, you can see when prices traded through previous day's high on Thursday, because I went long on Thursday. Okay, you can see what happened on Friday. Friday closed below what this consecutive up candles. That is your change in state in delivery. That's your bearish order block. Now you're waiting for this week to define buys. Now, say we're not trading on Monday, and Tuesday was indecisive, but market is literally consolidating, because all of this thing is consolidation. Because look at the weekly bias. If you look at these candlesticks with reference to the expression of the weekly bias, you see that this is consolidation. And that's why I don't like trading on Mondays. I don't like trading on Mondays. Monday's confirmation is a confirmation protocol for me for my weekly bias. So I'm going to see how Monday trades. Now, if Monday trades bullish like this, and I want to be short on USDJPY, I can't trade on Tuesday, because if Monday is bullish, this is not validating the weekly bias. This is a bullish candlesticks inside the key level on the daily time frame, so I can't do anything on Tuesday. Now, Tuesday closed indecisive, and I talked about a very simple trading model. Once you're under a bias and markets create an indecisive candle like this, and markets trade above the previous candle's high, that's your framework. That's your framework for a setup. So a run above previous day's high, when institutional order flow is bearish, the weekly bias is bearish, that's a torus. You can see the rejection and see how the candle on Wednesday closed. So you want to go in on Thursday looking for what? Bearish prices. So you see, if you want to trade effectively, there has to be lots of patience. If you're not patient looking at daily time frame, looking at market structure, still focusing on the high time frame bias, the draw on liquidity, you're going to get lost on lower time frame. So you can see a change state in delivery here, validating the weekly bias, but that's not good enough, because the markets can still trade however the markets want to trade. The markets can run above previous days high, this high, and sell off. So for this particular week, you are looking for validation for the weekly bias. Although you have your key levels, but the markets can trade however the markets is going to trade. So you're looking for validation. And what's your validation? This level, this pin bar. This is what they're going to do, inverted hammer and stuff. That's your validation here. Trades above previous days high, 1, 2. Trades into this level here, the bearish order block, and markets just sank overnight, which is very, very painful. And you look at the 4-hour time frame, and so interesting. You can see how markets trade above previous high here. Markets trade above previous high here. And markets consolidate above previous high. Markets just purging buy side liquidity here. That's markets just absorbing all of the buy side liquidity resting above this high, and the markets broke down. Okay, look at this candle. As soon as this candle closed, you can sell short here and your stops here, hoping markets trades lower and runs sell side resting below here. Because from my weekend analysis, this was my objective, relatively equal lows here. Okay, relatively equal lows. Someone say, oh, market took sell side. Well, you can see market return back into this range here. That's mitigation. That's mitigation, making low resistance liquidity run. And markets couldn't effectively run through here, so markets consolidated, return back to what the key level on the 4-hour time frame. Oh, I thought this level was mitigated. It's not going to hold. Markets can do however they want to. Oh, Cello Black, what about, why don't we just, why don't you look at this? Is this not a fresh OB, mitigated OB and stuff? Let's look closely and let's see. The markets never trade into it. So someone is going to say, oh, market missed my limits. Well, this is the key level. If markets weren't consolidating, market wouldn't have to even return here. If markets were not even consolidated, it's impossible the markets didn't even make return into this level. It's only consolidation that makes market refer back to key reference points. It's just consolidation. And that's why what's the most important thing for you to do is understanding the high time for institutional order flow. And that's why I spend most of my time defining what the high time from institutional order flow is, because that's everything. Every other thing revolves around it. Is the central mass, and every other thing, market structure, everything propagates in the direction of the high time from institutional order flow. If I recall myself, I said market structure bends to the will of the high time from institutional order flow, because that's the most important thing you want to be figuring out. Not all mitigated OBs and then you miss a limit and then your psychology is ruined. Grow some balls. Learn to hold trades. Learn to put your money where your mouth is. So I hope you found this one insightful. Until the next installment, be safe.